Welcome back to the Deep Dive. We've got a great set of sources you sent in, all covering the very sharp end of December 2025, the latest on risk, the Fed, and some really critical asset movements. Our mission today is to give you a shortcut, really, to distill the key signals from macro, from equities, and from crypto to give you a full picture of the current investment thesis. And what we're seeing is this fascinating tension. You've got the Fed on one side, quietly working on the plumbing of the financial system, and on the other, you have investors sort of in a defensive crouch, just waiting for the next big shoe to drop. The whole mood is, as one source put it, event-driven plus position caution. This caution, when you mix it with high leverage in certain corners of the market, is leading to these wild volatility spikes in everything from big tech to digital assets.
Okay, let's unpack this right away because the central bank's recent moves are really the engine here. What is the core policy signal that's affecting short-term funding? It's not the rate, is it?
It's absolutely not the rate. And that's what's so fascinating. The market is laser focused on a highly operational move, something that happens kind of behind the scenes. The Federal Reserve is actively implementing what they call reserve management purchases, or RMP. They detailed it in a recent implementation note.
Reserve management purchases. Okay, that sounds very technical, almost like they're just fixing a leaky faucet in the background. What does RMP actually do?
That's a great way to put it. Think of it as the Fed proactively topping up the financial system's most essential bank accounts, the reserves commercial banks hold at the Fed.
Right.
After years of, running down their balance sheet, they realized the amount of reserve liquidity had just gotten too low. The system can get brittle if those reserves are scarce.
So this is about stability.
Exactly. The New York Fed is executing this to supplement those reserves and just stabilize that short end of the market where all the day-to-day funding happens.
So what's the scale we're talking about?
It's significant for a technical operation. They're set to purchase about $40 billion in the first month alone.
$40 billion.
And they're focusing specifically on short-term treasury bills. So they're basically exchanging cash for short-dated debt just to increase the overall pool of liquidity.
Okay, but that distinction between rate policy and these balance sheet mechanics, that's where the real controversy is, right? The one we saw flagged in the institutional sources. I mean, if the Fed is injecting $40 billion, how does the market not see this as just plain old quantitative easing, or what some are calling stealth QE?
That is the defining debate right now. It really is. And how you answer that question determines your long-term positioning.
So what's the Fed's official line?
Their line is that RMP is purely an operational necessity. They need the plumbing to work so monetary policy can be transmitted effectively. They argue it's not designed to stimulate the economy or lower long-term rates.
Just fixing a technical problem.
Just fixing a technical problem. However, if you connect this to the bigger picture, the effect, well, it looks a lot like QE on the margin. The Fed is buying assets. It's expanding its balance sheet.
And perception becomes reality.
Exactly. If institutions start to see this RMP as a permanent, non-traditional kind of QE, even a small one, it fundamentally changes how they price risk and inflation, even with the 10-year Treasury yield still hanging around 4.14%.
So RMP is stabilizing the short term, but how does that stack up against the broader, longer-term rate picture, especially with inflation still lingering?
Well, the rates landscape is the backdrop for all of this. The 10-year is firm, like I said, around 4.14%, but the 2-year is closer to 3.49%.
Okay.
That gap, or lack thereof, between the short-term yields, which are being affected by the Fed's actions, and the long-term yields shows the market is still wrestling with future policy. Because inflation is coming down, but it's slow, and it's still above their target. So the Fed has to be cautious. They're stuck in this gradual and operational mode.
They can't signal aggressive cuts.
Not without risking an inflation rebound. So this whole dynamic puts the execution pace of RMP firmly in the spotlight. It's the dominant short-term catalyst.
This is where it gets really interesting for me, moving from policy to actual behavior. Capital flows. If the picture is RMP and caution, how are investors showing it?
You can see it clear as day in the flows. There's a very noticeable trend of short-term capital moving defensively, pulling funds out of riskier assets and
Where's it going?
straight into perceived safe havens. We're talking money market funds and ultra short-term debt. And if you look at the broad indices versus the growth sectors, the defensiveness is just palpable. Investors are shedding beta.
Okay, so we can measure that nervousness with the VIX, right? The fear index. It's around 16, maybe 17. That's actually pretty tame. But, and this is the disconnect, the crypto fear and greed index is screaming extreme fear, down near 20. So why is the VIX so calm? Is the traditional market just walling off the crypto risk, or are we missing something?
That is a brilliant observation. It really highlights the divergence we're seeing. The VIX at 16 suggests that systemic traditional risk is still seen as low.
Probably because of the RMP.
I think so, yes. The Fed's visible hand is calming the waters. But the crypto fear index at 20, that's a sector-specific panic. And that extreme fear is usually driven by high-leverage liquidations, wiping out speculative traders, not by big institutional macro shifts. For now, the traditional market seems comfortable treating crypto as a high-beta, contained risk.
And what about globally? How does this defensive mood look in the currency markets? The dollar index, the DXY, is still pretty firm?
It is. The DXY is holding firm around 98.6, and that dollar strength puts constant pressure on global risk assets.
Right. Harder to service dollar-denominated debt in emerging markets.
Exactly. And it weighs on commodities priced in dollars.
Yeah.
That link between the Fed's domestic plumbing operation and, global distress is often overlooked, but it's a direct consequence.
Let's transition to the specific assets everyone is watching. What are the key ranges and drivers right now?
It's that same story of divergence. The widened indices are pretty stable. VOO, the S&P 500 ETF, is holding steady in the $620 to $635 range. That shows broad corporate resilience.
But the NASDAQ is a different story.
A very different story. QQQM, the NASDAQ 100 ETF, is way more volatile, sitting near $252, and it's all because of its heavy tech weighting, which leads us straight to the geopolitical pressure point of the week, NVDA.
NVDA. The bellwether for the whole AI narrative. It's trading near, $176 to $181, and it seems incredibly sensitive to every single headline. What's the latest on the H200 chip exports to China?
This is just a perfect example of geopolitics driving a stock price over fundamentals. The news cycle has been brutal. Reports suggest that, yes, clearance for the H200 has been granted.
There's always a but.
There's always a but. It comes with conditions and heightened regulatory scrutiny. The market is basically trying to read tea leaves in Beijing. It feels like it's 50% technical analysis and 50% governmental guesswork.
And that uncertainty is the real anchor.
It is. You just can't predict the revenue when the rules can change overnight. Meanwhile, other players like Meta and Google, their volatility is driven more by their ad outlook or progress in commercializing AI. It's more normal.
Okay, let's turn to crypto. The majors have pulled back pretty hard from those recent highs. What's the snapshot for BTC and ETH?
Yeah, that pullback is a clear sign that the high leverage in the system just unwound very quickly after it failed to break that psychological $90,000 level for Bitcoin.
So where is it now?
Bitcoin is trading around $88,174, holding in a tight range between $85,000 and $89,000. Its movement is just tied to leverage liquidations. Ethereum is near $2,827 and faces similar risks, but they're amplified on the derivative side.
And that Bitcoin to gold ratio we track, what's that telling us?
It's receded slightly to about 20.22. Gold is holding up around $4,361 an ounce. When that ratio falls, it just means Bitcoin is underperforming gold.
Confirming the risk-off mood.
Exactly what the Crypto Fear and Greed Index was telling us. Investors are rotating slightly away from the volatile digital asset and back toward the traditional inflation hedge.
Beyond the majors, though, you flagged some interesting transaction-driven opportunities in fintech, companies focused on compliance and expansion.
Correct. When the macro market is sluggish, companies that just execute well can really shine. You see this with brokerage and exchange stocks. CRCL is trading near $81 to $86, and it's benefiting from good news on licensing in the Middle East.
Opening up new markets.
Right, new geographies for transaction flow. And similarly, a coin near $270 is being driven by its internationalization efforts, especially in places like India. These are specific execution-based stories that stand apart from the broader noise.
But then you have the really fringe stuff. The highest beta, most speculative assets. This is where the danger is, right? Especially with that extreme fear reading.
Absolutely. You have to approach things like pre-stocks. We're talking shares in private companies like XAI or Anthropic and what we call HYPE tokens with extreme caution.
What exactly is a HYPE token?
It's the highly speculative, often unaudited tokens tied to new meme projects or narratives. They carry maximum counterparty risk. You have to be so careful about fraudulent contract addresses and custody risks where huge amounts of tokens can suddenly flood the market.
Okay, so let's bring it all together. Given the RMP, the NVDA volatility, the crypto caution,
Well,
what are the recommended risk management strategies?
the overarching strategy has to be flexibility. You have to maintain a defensive cash allocation and please confirm news before acting aggressively. Don't chase the headlines.
So for broad exposure like VOO and QQQM,
It's about phased entry. Accumulate on pullbacks, but keep significant cash reserves. That cash is your dry powder. It lets you capitalize on volatility instead of being a victor of it.
and how do you hedge the specific risk from the Fed's RMP operation?
Well, since it's directly affecting the short end of the curve, a smart hedge is a small allocation to short-term bonds, high-quality money market funds, or even gold ETFs. They give you downside protection against those short-end rate fluctuations. And for tech, for the NVDA situation, treat the news as announced but needing verification. If real orders materialize, that's your green light to scale in on dips. But if regulatory clarity gets worse,
Stop loss is mandatory.
it's essential to protect against those sudden geopolitical shifts.
And finally, the advice for the most volatile assets.
For crypto, just keep the exposure small and non-leveraged. You have to strongly avoid high leverage or perpetuals right now. And for things like pre-stocks and HYPE tokens, it demands rigorous personal verification of the contract security and custody details. If you can't verify it, just don't touch it. This deep dive really shows that the market's being pulled by two very different, very powerful forces. You have the technical reconfiguration of liquidity through RMP, and then you have this almost chaotic volatility from isolated news, like the NVDA saga, combined with that relentless high leverage in the digital asset space. The most challenging point, and the thing that's still being hotly debated at top institutions, is whether the Fed's RMP is genuinely just a technical operation, or if it's a controversial, non-traditional form of QE by another name. And that raises a really important question for you to explore. How might your long-term asset allocation strategy change if RMP is eventually seen by the wider market as a permanent structural shift in the Fed's toolkit, moving them closer to perpetual balance sheet management?